Hi, Matt Batty here again. Just want to do a quick update on interest rates. So we've just had the latest round of RBA interest rate settings, and we've now seen the official overnight cash rate move up to 1.85%. So obviously that's a pretty severe rise in a relatively short space in time. It wasn't that long ago that the RBA rate was at 0.1, so obviously 1.75 in a pretty short space of time. So what does that mean, and how does that sort of fit into our expectations and our outlook? Well, I guess the good news is that's very much in line with what we expected. As we've mentioned in previous videos, our expectation is that the RBA would move to fairly aggressively move rates. And in fact, if anything, probably that would result in too much tightening too quickly. And we're now actually seeing that play out if we look at what's happened to the yield curve. So yield curve, for those who aren't aware, yield curve basically is how do interest rates, or the level of interest rates, change basically with duration, so longer term. So how do short-term rates, sort of 30, 90, 1 year rates compared to say 10, 20 year rates for things like government bonds and longer dated sort of interest rate securities. So a normal yield curve is interest rates are relatively low in the short term and they rise and sort of flatten out. But occasionally we get what we call an inverted yield curve, and that is where long-term rates are actually lower than the short-term rates. And that's basically what we're seeing now. In other words, the market is expecting that rates probably sometime early next year will actually need to be cut. Now, that doesn't mean that the RBA won't continue to raise rates a little bit more for the balance of the year, although they do seem to be changing their tune a little bit with respect to that. But we're already at a level where we believe that rates are, the effect of those rates haven't yet sort of moved in. So what do we do about that? Well, the outlook now for mortgages has changed quite significantly. Obviously, we had rates that were only a few percent not too long ago, and we've seen essentially almost a doubling of particularly home loan rates that were sort of down around the low twos, or even a bit lower than that in some cases. So reviewing home loans is going to be an important part of your strategy going forward. Now, many of our clients don't really have much in the way of debt, or particularly those who are retired. But if you have children or other family members who have, and particularly haven't reviewed their loans for a couple of years, it's probably a good idea to start looking at what deals there are in the marketplace, and particularly the difference between variable rate packages and fixed rate packages, because those fixed rates accelerated pretty quickly as the expectation of rate rises moved, and that delta is going to change a bit over the next couple of months. So that'll be the first thing, look at reviewing any debts that we have, but also that changes now, particularly gearing strategies, and even some of the intergenerational strategies we look at with different clients as well. So without going into a lot of detail about all the different ways and that might be exploited, I guess we want to let you know that there are different strategies that we'll be looking at coming through the next 6 to 12 months, now that interest rates are moving back to a more, let's say, normal type of level. But really the key at this rate is we're going to get a little bit more return on cash. So obviously retaining cash through relatively uncertain times is always a reasonably good idea. There's going to be a bit more volatility in the market for the next probably 3 to 6 months, but at least our cash is going to be earning a little bit better. But most importantly, it is time to start reviewing debt strategies, because the interest rate differentials in the last few years has clearly changed, and that's unlikely to change substantially going forward. So reviewing home loans and reviewing strategies, particularly in relation to debt versus superannuation, some of those things, those fundamentals have changed a bit as well. So there are certainly things we'll be discussing with you over the coming months, particularly over the next sort of 6 to 12. So I just want to let you know that we are obviously keeping an eye on this, and things will start to change potentially for some clients. But as always, if you've got any questions, let us know, reach out, and we'd be happy to answer anything you want to know.